The year is 1944. World War II is nearing its end, and world leaders convene at the Bretton Woods Conference in New Hampshire. Their mission, to design a new international monetary system. From this gathering emerged the International Monetary Fund and the World Bank. These institutions aimed to foster global cooperation and shared prosperity. The IMF maintained global financial stability, while the World Bank financed reconstruction and development. Together, they embodied the hopes for peace and prosperity after years of conflict. The IMF's primary role is to function as a global lender of last resort. When countries face economic crises, often marked by dwindling foreign exchange reserves and unsustainable debt levels, the IMF can provide emergency loans to help them stabilize their economies. These loans, however, come with strings attached. The IMF typically imposes conditions on its lending, requiring recipient countries to implement specific economic reforms as a prerequisite for receiving financial assistance. These conditions, known as structural adjustment programs, often involve austerity measures such as cuts to government spending and subsidies, as well as policies aimed at liberalizing markets and promoting privatization. While proponents argue that these reforms are necessary to address underlying economic imbalances and promote sustainable growth, critics contend that they can have detrimental social consequences, particularly for the most vulnerable segments of society. Austerity measures, for example, can lead to cuts in essential public services like healthcare and education, disproportionately impacting the poor and marginalized. Unlike the IMF's focus on short-term macroeconomic stabilization, the World Bank concentrates on long-term development projects. These include investments in infrastructure, education, healthcare, and other sectors deemed crucial for reducing poverty and fostering economic growth in developing countries. The World Bank provides loans, grants, and technical assistance to developing nations, often at concessional rates, to support these projects. Its stated mission is to help countries achieve the Sustainable Development Goals, a set of ambitious targets adopted by the United Nations in 2015 to address global challenges like poverty, inequality, and climate change. However, the World Bank's lending practices have also drawn criticism, particularly concerning the issue of debt sustainability. Some argue that excessive borrowing from the World Bank can trap developing countries in a cycle of indebtedness, diverting scarce resources away from essential services to repay loans. Critics also point to concerns about the environmental and social impacts of some World Bank-funded projects, such as large-scale dams or mining operations, which can displace communities and harm ecosystems. A persistent critique of the IMF and World Bank centers on their governance structures and the influence of wealthy nations. Voting power is determined by economic size, giving developed economies disproportionate control. Critics argue this power imbalance undermines the legitimacy and effectiveness of these institutions. They point to policies that have exacerbated inequality and promoted wealthy nations' interests. The IMF and World Bank generate revenue through interest payments on loans. Critics argue that interest rates can burden developing countries, hindering sustainable development. The debate reflects broader questions about power balance and achieving equitable development. These institutions have promoted global stability, but their legacy remains under scrutiny.